Good afternoon. Welcome to the National Press Club. My name is Larry Lipman, and I am the Washington correspondent for the Palm Beach Post in the Cox Newspaper's Washington Bureau and Vice Chairman of the National Press Club's Board of Governors. I'd like to welcome club members and their guests in the audience today, as well as those of you watching on C-SPAN or listening to this program on National Radio or the Global Internet Computer Network. Before introducing our head table, I'd like to remind our members of some upcoming speakers. On Wednesday, May 29th, British Foreign Secretary Malcolm Rifkin will give a major speech on transatlantic relations. On Monday, May 3rd, former President Gerald R. Ford will present the annual Ford Foundation Journalism Awards for reporting on the presidency and national defense. And on Tuesday, June 4th, Secretary of Commerce Mickey Cantor will address a Press Club audience. Transcripts and audio and videotapes of Press Club luncheons are available by calling 1-800-NPC-2334. If you have any questions for our speakers, and I hope you do, please write them on the cards provided at your table and pass them up to the head table and finally down to me, and I will ask as many as time permits. I would now like to introduce our head table guests and ask them to stand briefly when their names are called. Please hold your applause until the end. From your right, Al Snyder, the Annenberg Group. Mary Arnold, a Fool. Dean Faust, Business Week. Margaret Gardner, a Foolophile. Carl Sullivan, Financial Planning Magazine. Skipping one of our speakers. On this side, Peggy Roberson, freelance journalist and chairman of the National Press Club Speakers Committee. I'll skip the next guest for a second. Jack Reynolds Communications, and a member of the Press Club Speakers Committee, and the person who arranged today's luncheon. Eric Rydholm, Vice Fool. Linda Boydston, just simply, Laura Boydston, Fool. I think I skipped somebody. Frank Best, U.S. Medicine. Sorry, Frank. Robin Mazzoli, Bloomberg Business News. And Tracy Longo, Kiplinger Personal Finance Magazine. Our musical guest this afternoon is Motley Fool. They will be performing from their CD Decade of Decadence, including Smoking in the Boys' Room, Girls, 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 and Primal Scream. My wife told me not to try to be funny and let the fools speak for themselves. Our guests today, David and Tom Gardner, have become the preeminent celebrities of cyberspace. They go by the name Motley Fool and are the most popular folks on America Online. In less than 2 years, their firm's main message board has received more than 250,000 postings. And that's not counting the individual postings on various stocks which are alphabetically listed. Their name comes from Shakespeare's As You Like It, but as you can see, they are far from motley, the original meaning of which is multicolored, and as for fools, their model portfolio far outperforms all of Wall Street's cherished indices. Since its inception in 1994, the Fool's portfolio is up 267.13%. By comparison, the Standard & Poor's Index is up 46.76, and NASDAQ is up 72.80. These fools and their foolish followers are laughing all the way to the bank. Part of their act is to debunk the existing financial advice industry in all its forms, from mutual fund managers to market timers to stockbrokers and the financial press. In medieval times, the fool had a key role to play. He was the one person who could tell the king the truth without losing his head. Most of the time, depending on the king, anyway. Motley Fool has become a cottage financial advice industry. Their Alexandria headquarters is called Folly Central. In addition to their online service, they do a monthly column for Smart Money magazine, and have published an investment guide on the market subtitled, How the Fool Beats Wall Street's Wise Men, and You Can Too. Here's David's resume, as stolen directly from America Online. David Gardner graduated as a Moorhead Scholar from the University of North Carolina at Chapel Hill in 1988. With many ideas and no regrets, he quit his job writing for Louis Rukeyser's Wall Street in order to start the Motley Fool in July of 1993. 3 years later, lo and behold, the Motley Fool has become the most popular online investment site, and David and his brother Tom are best-selling authors. The Motley Fool Investment Guide, Simon & Schuster, 1966. 96. Yeah, 30 years. David is married with child, and it says here in parentheses, although fortunately his wife delivered it. And now a second is on the way. He's an avid reader, an uninteresting golfer, an erstwhile thespian, and he thinks the media is as wrong about analyzing sports as it is about analyzing investments. You're probably in good company here. Unusual in this age, he never, and this is in all caps, attended graduate school anywhere for anything. How's that for foolish? Now here's Tom's resume, again ripped off from AOL. Tom Gardner, a graduate of Brown University, recently relinquished teaching business and investing at the University of Montana in order to devote his efforts full-time to cyberspace. Tom's creative mind is largely behind the organization and offerings of the Motley Fool online, and his written work forms the backbone of the Motley Fool Investment Primer, in which he exhibits his style of teaching using straight talk and entertaining examples. Tom actually is kind of a fan of Larry King, who may end up being largely responsible for third-party politics in America. Tom lives and works out of Alexandria, Virginia, and New York City. Beneath all this foolishness is a serious purpose: to provide the untutored investor with enough accurate information to build their own successful portfolio. Their method combines research with common sense, and as they say, thanks to online communication, it is now little guy investors, not huge brokerage firms, who hold the most valuable cards. And thanks to Dave and Tom Gardner, the old saying about a fool and his money are soon parted may be changed to a fool and his money are soon doubled. Motley Fool, teach us how to grow rich.
Thank you so much, Larry. Thank you to everyone at the Press Club, particularly Peggy and Jack, for having us and organizing this wonderful luncheon. And it was a great pleasure for us to be able to bring in a lot of members of our company and family to the event. So we've actually stocked the tables and the attendance today. We have a claque. And it was free. I think we have to begin by actually donning our fool's caps because, let's face it, I don't think anyone's probably ever done this in the National Press Club before. Okay, now we can talk. I'm going to talk for 10 or 12 minutes, and then Tom's going to follow up with the intelligent portion of the program. I'd like to start with a story. It's a fairy tale. Once upon a time, there was a prosperous country called America. America had fertile land, sun-struck coasts, purple mountains, and a happy people. She sported free public education, expensive but effective health care, and high-speed data networks that anybody could tap into with a modem. In America, more than any other place ever, you could do and say what you wanted, and your destiny was largely, to an almost disturbing extent, your own hands. In fact, despite the protestations of whichever political part of power at the time, America was the envy of the world. But there was one thing that Americans lacked. Despite their comparatively rich status, Americans had very little understanding of what to do with their money. Most Americans would build up some savings by their middle years and suddenly find they had no real idea how to handle it. As they were mostly a good people, their instincts were right. Save the money and make it grow. But how to save it, make it grow, was something most had never learned a thing about. Maybe it had something to do with their educational system. Their schools, particularly the best ones, focused on the liberal arts, languages, literature, history, philosophy, science, and mathematics. Many of them, for instance, were taught calculus before college. Yet few were taught anything about indexes, dividend yields, interest rates, or discount brokers before or after college. There was no formal education of any kind about money. But what would most of them work the better part of their adult lives to obtain? What would enable them to buy the house, the car, or to retire, or to put their children through school? It was into this fairy tale land that we launched the Motley Fool, as a small print newsletter not even 3 years ago. In July of 1993, I, my brother Tom, and our friend Eric Rydholm, small subversive movement in the financial world, printing our first issue of what began as a newsletter for family and friends, the Motley Fool. Fool. Financial advice with the word fool attached to it. Many of our friends were highly skeptical of the viability of the enterprise. Then again, many of our friends worked for Wall Street. In fact, we needed to look no further for evidence of skepticism than the number of initial subscriptions we did after our 2 months of business, 48. But it was the journalist Herbert Swope who reminds us, I cannot give you the formula for success, but I can give you the formula for failure, which is try to please everybody. You see, Tom and I were actually just English majors trying to please ourselves. We've never been money managers, brokers, or financial journalists of any conventional stripe. We're just writers who happen to have a dad who taught the stock market early on, even gave us some money to manage on our own when we turned 18 so that we could try to figure the darn thing out. Shakespeare was a favorite of ours, go to college, and the theme of folly and wisdom has a very rich literary history. Not coincidentally, perhaps, most of my favorite authors have spoken kind of fools. Plato, St. Paul, Erasmus, and Shakespeare. We selected our name, as Larry mentioned, from one of the Bard's great passages about fools from As You Like. Act 2, Scene 7. Jaques enters, having just come a jester in the forest. Jaques excitedly proclaims that he himself is ambitious for a motley coat. Invest me in my motley, he says. Me leave to speak my mind, and I will through and through cleanse the foul body of the infected if they will patiently receive my medicine. For our own part, we thought that if the medicine were expressed in simple terms regarding a subject that concerns everyone's bank balance, with generouses of a whimsical and self-effacing humor mixed in, maybe, just maybe, the world would receive ours patiently. Our first break came when, on our own initiative and as paying customers, we opened up interactive discussions on a few different online services, signing online late each night during the winter of 1993-94. We answer reader questions in a message folder with the unabashed of the Motley Fool. There we announced our intention to answer any investment question that came our way. If we didn't know, which we often didn't, we'd do our darndest to track it down. 3 months later, in February of 1904, our discussion had become the most popular draw on America Online's personal finance area. They wanted to see a few copies of our print letter, and a few months later, we signed a deal to go on with AOL. We did on August 4th of 1994. The Fool has since grown into a company of 30 full-time employees and more than 100 remote staffers spread across the nation. That staff is nevertheless small, considering it services the needs of several 100,000 customers who come through the area every month. We now have a best-selling book on investing, but honestly, I'm sick of talking about us, so let's talk about why all this is happening. Our emphasis from the beginning was on reform. It's right there in the As You Like It quotation. We set out to cleanse the foul body of the infected financial world. The notion that we could actually succeed at this may seem outlandish, coming from two young whippersnappers. But we had a few unforeseen advantages, not the least of which was a fervent belief in and a fairly advanced understanding of the most powerful medium that history has ever seen, the online medium. That gave us a head start. But Tom can talk about this as the online medium. I'd like to close by focusing on what was wrong with Wall Street, what continues to be wrong in some senses with Wall Street. Not surprisingly, it does concern institutions, because it is the institutions of Wall Street that have grown big, that have grown institutional by taking advantage of the general public's total lack of education about investing. The institutions I'm going to focus on are three of the mutual funds, Wall Street brokerage firms, and yes, even in these hallowed halls, the press. The typical investment recommended today by most financial planners, most financial publishers, and most journalists is the mutual fund. Mutual funds are, like youth-worshipping advertising and internet hype, all the rage. Not hard to figure out. When investing in a mutual fund, you are handing over the care and responsibility for your money to someone else. Really a very typical response most people have when faced with something they don't understand. It feels safe, comforting to give our money over to others who wear expensive suits on television and tell us they're wise and prudent and successful. And mutual funds are certainly a better option than most of the others out there, like state-sponsored lotteries, Las Vegas, credit card debt, or infomercial real estate tips. However, it doesn't even take a fool to notice now that 80% of all mutual funds actually underperform the stock market's average annual return. That's right. Billions and billions of dollars handed over to some pretty well-paid fellas, our country's mutual fund managers, don't even return investors the stock market's average performance year in and year out. Would a Wall Street broker be a better choice? Well, offering more personal service, they are a common answer, and there are some good brokers. Problem is, though, that most are paid based on how often your account is traded, not on. Talk about conflicts of interest. Insofar as you pay a commission each time you trade an investment, it is not in the interest of the average investor, and yet Wall Street has grown to the size that it has, partly because it has convinced investors to move in and out, and in and out. Never mind how bad this is for your bottom line. Many of our readers today have come to us after a horrible experience with a broker. So, given the mediocrity of mutual funds and the bad system in place at U.S. brokerage firms, you naturally turn for help to your third option, the fourth estate. But what good has the traditional investment press really done us? Well, there are a few genuinely good writers, as usual, but every day the majority of our investment writers at our nation's most respectable papers spend their ink on trying to gauge where the market is headed. This would seem the end of today's financial journalism, if it were possible. Of course, our press has been taught to get others to think for it. Journalists daren't say themselves what they're actually thinking. In most cases, the trick is to find someone else to do it for them. So they regularly solicit financial forecasts from all manner of so-called gurus, people who are well known in financial pages for being well known. Alan Leftwich at Bear Stearns sees the Dow Jones average plummeting to 5,200 by the end of August. You'll typically read in the Wall Street Journal, but who is Alan Leftwich? What's his past record? The Journal is fortunately silent on it. It is enough that he is a professional at a Wall Street firm. And when August rolls around, will the Journal be there reminding us what Mr. Leftwich said? No. What it will probably do is instead quote him again, creating another financial prediction made with no follow-up, no accountability. Imagine a financial press that eschewed its infatuation with forecasting the market and instead sought to educate its readership by focusing on current examples of great stocks and the great companies behind them, explaining the why, not just telling the what. Imagine a broker whose pay was tied to the long-term success of his clients' portfolios, instead of frenetic, short-term dabbling in other people's money. Imagine a mutual fund industry that had billions of its dollars pulled away from it back into the accounts of people who understood the mediocrity of these funds, who understood the benefits of managing one's own money to market-beating satisfaction. And imagine a nation whose collective understanding of money was rapidly improved, resulting in greatly increased national savings, better business, and enlightenment in all financial matters gone rampant. At Fool headquarters, we are fully and intensely focused on converting those visions into palpable realities today. I'd like to close with one observation before turning it over to Tom. That is that what we are seeing today is the product of private industry, not government intervention, bringing about these reforms. Through an effective and disciplined use of this new online medium, our small private editorial organization is dramatically rewriting the rules to individual investors, the little guys who were, for decades, disenfranchised by the status quo. In an era of Brobdingnagian government, this is highly ironic. In fact, it's not unlike a fairy tale. Thank you.
I want to actually just talk a little bit about, and a little more informally, why we went online, why we took this out of print publishing. There were plenty of opportunities, I think, for us to grow a pretty healthy business off fax services and print publications and publishing. And yet we went online, we collapsed all of the print work that we were doing for our 350 subscribers. So I don't want to overestimate how well we were. But we first of all, from a business standpoint, saw really no overhead costs. All of a sudden, we had no print, paper, mailing costs, and we had national distribution on America Online, and now on the World Wide Web. And the biggest investment that we had to make, beyond the couple $1,000s to get 2 computers and 2 phone lines, and the occasional purchase of the good graces of certain who on the back of whose property we sat for 15 to 20 hours a day, working away at computers. The biggest investment we had to make was in the notion that there was a new structure for teaching people, that the conventional approach of I am standing up on stage, the microphone is below my nose, and therefore I know more than everyone here. I am the professor at your university, or I am the preacher at your church, or I am using television, radio, or print publishing as a one-way broadcast medium to teach you something, the unwashed masses. We needed to invest in the idea that that simply was not an accurate reflection of the sort of intelligence, wit, sophistication of people across the country. And that was the advantage that America Online gave to us. We recognize that the masses are not ignorant, that someone who wants to learn is not ignorant. And it is my feeling, and I think our feeling at Fool HQ, that the press still treats, the financial press still treats their readership as if they're not sophisticated investors. We have found that not to be true. We did not find a perfect world in the online medium, and we don't today. Reading computers reading off a monitor from a foot away is not ideal, particularly with $3 an hour on America Online with that clock ticking. I don't think people are racing home to their living to read Charles Dickens from a foot away at $3 an hour. So we definitely need to see some changes in the design of technology and in the pricing structure to make this affordable for everyone. Right now, we're catering to a select group of technologists and people who can afford computers, and we would much rather broadcast as a consumer who publishes things at very low cost that can be distributed to everyone. And this is, I think, fundamentally opposed to, or the antithesis of what Wall Street has been doing, treatment of information and its clients. We wanted to, in the words of Woodrow Wilson, make this America about everyone, not a situation. America is about individuals, or America is about some of us, but America is about access to information for everyone. And what more important information than financial information or medical information or a whole variety of different business or entertainment information that heretofore people didn't really have access to. So that was really the first step that we took coming online. And this is not something that we've planned out in advance. We gradually, in the process of interacting with people, began to realize what it is that they needed and what we could provide. And the first thing was simply introducing Wall Street to Main Street, getting the financial establishment to understand who the people are out there that they're working for. So the first thing was just a simple introduction, and that meant opening out what are essentially exclusive conversations between Wall Street insiders and public companies. Conversations that you and I as individuals didn't really have access to. A perfect example is simply the conference call. The conference call with analysts at the end of every quarter is an opportunity for analysts and brokers primarily to speak directly with company bigwigs, CEOs, and the executive team. And there are still exclusive meetings that, even though we now have access to a lot of them, can report on them back out to America Online so that people can review these materials themselves, and often now increasingly send us questions to ask. Even with that, there are still instances today where information is not distributed equally. And that is an advantage that I think we're going to see the end of with the growth in the online medium. So the first thing, I guess I should rush a little bit, the first thing that we wanted to do was just Expose the business models of Wall Street to people across America and give them equal access to information. The second thing that we wanted to do was to align the best interests of Wall Street with the best interests of the individual investor. That actually this isn't a zero-sum game, that there's a circular function here, and there's opportunities for growth for everyone in an educational environment. Warren Buffett has made a career off investing in consumer demand businesses. We saw a great opportunity to leverage the work of consumers, and America's business is driven 65% by consumer demand. We saw a great opportunity to give consumers the information they needed to invest in the companies that they purchase products or use services of. And this is exactly the sort of company like Coca-Cola that Warren Buffett has invested in and made a small fortune off of. We saw an opportunity for everyone to participate in that, for that not to be a select situation where people felt, well, I don't know anything about investment, I never got any education, and yet I'm out using my credit cards and purchasing a lot of things. I know exactly what it is that I demand as a consumer, but I'm not able to follow that purchasing with investments. So we wanted to align the best interests to give research, to build research teams online among consumers that eventually, and I think already right now we're seeing Wall Street is taking a very active interest in what's going on because they need to know what mass consumer discussion is about a whole variety of public companies out there. They need to be in on that, and there's a good example of it in our forum. Rainforest Cafe, which is a themed entertainment restaurant, got a fairly big following online. The stock was trading only around $5 a share. It's a small, pretty much still a startup business, and people began researching what was going on with the development of Rainforest Cafe, which now has some pretty extensive agreements with Disney. This is a stock, by the way, that the Fool portfolio unfortunately did not participate in. But one of our staff members, who runs one of the largest Hispanic-owned businesses in Florida, is in the frozen foods industry, and what we first introduced, I think, and what he first introduced online is the idea that because I'm in this industry, because I use these products every day, I know more than the MBA-trained analyst who was assigned to the restaurant industry by a firm in Manhattan. I know, because of my experience and because of the opportunity now online to talk to other people about these restaurants and about the food industry, I actually have an advantage, because I use these products. So what happened was, because of Aristotle Muñoz and a variety of people that he built up, we ended up with a team of researchers who were going into the Rainforest Cafe asking anything that they thought would in any way give them more information about what the fair value of this company was. So as they build a new restaurant, we actually had fools talking to construction workers, talking to the contractor, asking what the costs of this are going to be, what sort of talking to various restaurants around and asking questions. And that's what's happening now. We are leveraging in a way that we may have dreamed possible over a long period of time, but it's happening much more rapidly than even we thought it would. We are having teams of hundreds of people searching out primarily consumer companies now and finding what it is, what products and services are most attractive to people, and they're working on financial statements together. That stock has gone from $5 a share to $45 a share in a year, and that 9 times their investment is still being portrayed a little bit in some situations as driven by these investors, when it's really driven by the education and the research. Understanding what it is that makes a great company grow. These companies have grown like this. Small caps have gone from 5 to 40 in 12 months for years, but individuals and consumers haven't had the opportunity to participate in that because they haven't had access to information. They haven't been able to research in an investment club format. To close, I really think that we have really only just begun here. The final step is essentially dissolving Wall Street into Main Street. Again, working together, collaborating, leaving behind the notion that we have we have a game that only a select group can win and other people can't participate in. That is not our feeling about open markets, and our feeling is that consumer businesses are going to continue to flourish now as more and more consumers can talk about the products and services that they use. And I do want to just close with one little follow-up on what David was saying about market predictions and how ridiculous we think they are. Occasionally we have to get dressed up in fool gear and let the media make fun of us just because we know getting our name out there is on occasion what counts. But Dr. Ethan Haskell is a doctor and a cardiologist in Baltimore who has set up a system with his 8-year-old son where his son works weekly for an allowance, half of which he then distributes back into stocks to purchase individual shares from his dad. So his dad doubled his weekly allowance and said, if you're willing to put half of this in stocks, I'll double your weekly allowance. So after a year now, his son has saved up $100, which he has invested, I believe, in 1.5 shares of General Electric. He's now looking to purchase shares of Hewlett-Packard. And his father then sat down, and he actually wrote an article up in our area, which has been, I think, very well received by the parents of America. And he simply wrote, with $100 saved now, if he's able to grow that in investment, General Electric has grown at a clip of about 20% a year over the last 10 years. The fools talk about some investment approaches that seem pretty simple that could generate 20% growth per year. So what would happen to that $100? At the age of 8, when he's 68, what will that $100 be worth if it grows at a rate of 20%? And the answer is $5.6 million. And that doesn't include commissions, and it doesn't include the taxes that you would have to pay there at the end. But I think it's a pretty telling statistic in terms of not trying to predict the market, adding money each month, and using the stock market as a savings vehicle that has a fairly predictable rate of return, rather than as something that's frothy today that you should be thinking about getting out of, that you need to generate more commissions for a financial establishment that has, I think, become addicted to them. Then, before ending his article, he simply said, well, what would happen if my son added another $100 a year? Just put another $100 a year away every year for the rest of his life and got 20% returns on that. And at the end of the 60 years, at the age of 68, he would have over $33 million, just putting $100 away and garnering 20% returns. At the end of the article, the editor's note was, Dr. Haskell is a cardiologist from Baltimore who is hoping to retire early on his son Michael's investments. And to close now, for certain, is this about making $30 million in 60 years? Probably not, but that's partially what it's about. Actually, what it's primarily about is getting structures in place and giving people a context to invest their own money so that we don't have so many people getting to the end of their college years with mounting credit card debt, reaching their adult years with minimal savings, and eventually taking some sort of speculative gamble on a Vancouver Stock Exchange 30-cent mining company that may not really exist. Rather than doing that, put money away, prepare for the future, expect some predictable rate of return from stocks, and hopefully have a hell of a lot of fun doing it. That's really been the aim of the Fool, and I hope that even when we grow beyond our capacity and only get an hour and a half of sleep like I did last night, we'll still be having fun. So, thank you.
Okay, I think Dave, for a first-time stock buyer, what would you recommend aside from reading your book?
Well, we actually, that's a very important person for us because that's the position that most people are in. Most people actually don't own any stocks at all. So our answer is that we do ask that they read our book first because our book provides them a context for understanding the decisions that they'll be making, which is what so many people lack. But the very first stock that we would typically suggest somebody buy would be one of the Dow, the big Dow dividend approach stocks that we teach in our book. These are basically some of the biggest companies in America that pay high dividends and are relatively safe. So, for example, in our Fool portfolio, we currently own a General Electric, which is one good example. We also own Chevron and Sears, two other good examples. And those are companies that whose fortunes you should feel pretty safe tying your fortune to. And it's a good launching point for investing. But again, those are selected using a specific approach that we teach in our book. So I wouldn't want somebody just to buy one of those stocks without really understanding why.
Before I go to the next question, I want to recognize Tom and Dave's grandfather who's sitting here. He's 93 years old, and thank you for being with us. And Dave said give all the hard questions to Tom. So, according to the Fool's principles, how does one, the inexperienced investor, go about creating a balanced portfolio, or is that a good idea?
Well, I think that it's a gradual process. I think initially people with smaller amounts of money are probably going to have to take on a little bit additional risk in terms of the number of investments that they can make. What we ultimately aim for is a portfolio with 8 to 12 stocks. That's a number of companies that you can follow without overloading yourself. And again, I think David said, just simply begin with the large capitalization stocks. One of the things that's so misunderstood, unfortunately, is the idea that companies, huge, very profitable companies, actually get overpriced in a way that would put you at risk. I would maintain that Microsoft, given its financial position, Nike, The Gap, Coca-Cola, these companies are never going to get overvalued in a way that will give you any sort of significant risk over a 5-year period. So I would balance it with large cap.
Given that you all are so closely identified with some of your portfolio stocks, America Online and iOmega, how do you sell out of them without triggering a crash in those stocks and losing all of your profits? And a related question, I understand that your personal investment policy has changed regarding the timing of your buys and sells, and could you explain that?
Sure. Let me take the second part first. We actually do have a fairly large following in terms of when we announce new moves in our portfolio, and we're not terribly surprised by that because our portfolio has done better than we actually deserve, but it's just reality being what it is. A fair number of people, once we announce that we're going to add a stock to our portfolio, tend to add it to theirs, and that has created over the last few months exaggerated moves in those stocks, whether up or down, based on a buy or a sell. And we're really not that comfortable with it. We don't derive any financial benefit from it, and the media sometimes picks it up and makes jokes at our expense about it. So what we decided to do was to announce, when we do, as we always do, the night before that we're going to make a trade. We're going to turn that to announcing it the week before we make a trade. In other words, we're still going to say, tomorrow we're buying X. I should say, we're still going to say we're buying X, but now it won't be that we're definitely doing it tomorrow. It is now that we will definitely be doing it at some point in the next 5 days, 5 market trading days, the next week, but not tomorrow, because we don't want to create that bubble, and I think this will smooth out some of the movements. It also gives people who just heard about the new pick that night the opportunity to research it some themselves. So that's the rationale behind it. And then the first part of the question was the notion that that some of our best stocks, I think in some people's minds, we sort of are pulling the strings on the market on these stocks because so many people are following these stocks supposedly because we own them and they've done very well. And so if and when we ever do announce a sell in one of these stocks, the market will crash because the Motley Fool announced a sell. Now, I think that's one of the most flattering questions we could ever be asked, because I honestly, I wish that were the case. In fact, some of our smaller holdings, ones that we would supposedly, I guess, have even more control over, have been some of our biggest losers. So the notion that when we say that we like the stock automatically does well is unfortunately not the case. We hope that one day it will be the case, but it's not the case. So what we say to that is that with our new policy, let's say we did announce we were selling America Online, which we're not, but let's say we did announce that, we would at some point in the next week sell it. That's our solemn commitment, but it won't be the next day. If the market wants to crash for some weird reason, and I don't think that it should, and I don't think that it will, but if it did, we would be able to wait a few days for it to recover its sanity. So that's sort of part of the mentality behind creating that new rule. And I'll just finish by saying that the only constant here is change. We say that we're building this plane as we fly it, and so we're always going to try to adapt to whatever we perceive to be the current circumstances. And in this particular case, we didn't like the current circumstances of the market moving on our next pick. And our very final line is really that keep in mind that most Wall Street firms, when they announce a buy or sell, already own millions of shares. And so what we're doing is fairly radically different from them, because we actually announce before we ever buy what we will be buying or selling. Thanks.
Speaking about those stocks that people have accused you of having an influence on, how and why did you start to focus on iOmega, and do you still feel it is a good value company?
We actually started because of our readers doing research. we weren't familiar with the zip drive. I don't know how many people are here, but it really is the revolutionary storage device that's on the market today. And we began because primarily one person who's an MIT PhD student in engineering, Charles Park, he began research just into the product primarily. And that really is the way that we start our research, or we like to, is to look at the products, look at the financials, not worry about the stock price. After a while, that folder began exploding. We saw the stock rise from $5 to $15 a share. And actually, these are situations that we like to find ourselves in, companies that have tripled, because that tells us that's a good screen to work off of. Not all of them are great, but that does tell us that things are better than they've ever been before with this company. The market perception of what's going on here is that there's real growth. And again, that doesn't mean it happens in all cases, but in this case, after doing the research, we decided that we should get some money in. And we never invest, say, more than 10 to 12% of our total assets in any one stock. So we didn't overload in it. We put $5,000 in it. The stock, which we purchased at 2.5, adjusting for the splits that have come since, is at 46 today, and that's in a single year. That happens in our mind because you have incredible consumer demand, and you have a management team that knows what they're doing. And so my feeling about it is it has moved up incredibly rapidly. When we begin to look at the financial statements, we may see a company and the projections for growth that is pretty fairly valued right now. But when you actually look at management and opportunities that can't be seen, like OEM deals, getting the drive into a computer, a Dell computer or a Compaq or any variety of these PC makers, if they're able to get this drive internalized in, their sales are going to go up even more rapidly than I think any of us can predict. And a last little bit on that, the disks is where they make their money, and so those profits really haven't flowed through yet. They get the drive out first as the platform for their higher margin sales in the way that Gillette does with their razor and their blades. The blades are the higher margin items. So it's very difficult to project where the stock is going. We're not really concerned about where it's going in a month, where it's going in 6 months. We're continuing to look at the company, and having had an opportunity to talk to a bunch of people when we were out at the shareholders meeting, we got a pretty good sense that they're in for the long haul. So we may be as well.
I've had several questions on the same theme here, so let me try this one. Do you expect to remain tied to America Online, or with the rapid expansion of the World Wide Web, do you see your method of expertise being available to those on the internet who have foolishly subscribed to some other net service?
Actually, our goal at Motley Fool is to be everywhere, and that's why we have an America Online site. We do have a World Wide Web site. We've got the book, we have the Smart Money column, and we're looking at other avenues of distribution as well. But that's our goal, because exposure is the biggest challenge to a small company like ours. Fortunately, through this new online technology, gaining exposure and serving people on a wide national basis is easier than ever before and can happen more quickly than ever before. So I'll just mention that yesterday in the Washington Post, Alan Sloan mentioned that America Online was in for some trouble, and it pointed out that the Motley Fool you can now get for free on the internet, so why do you need to pay America Online? To correct that, though, a little bit, I need to point out that the Motley Fool has been available on the internet for a couple months now. It is a popular site on the internet, but over that time, our America Online growth in usage from people has been in excess of 20% month over month. So that what we're really seeing is that our bets, which we're placing as many places as we can, are paying off in more than one. So I think, unfortunately, the media tends to view things too much as an either-or. Either America Online or the internet. Can't be both, but I don't think it's mutually exclusive.
Where did you get the money to begin investing, and how much money did you start with?
Thanks, Dad. We have a tradition in our family of trying to pass something down. It's not a tradition that I have yet been able to start, but I think that with David and Margaret and their daughter, it's going to continue. It is a tradition that you want to get your kids involved in the stock market in some respect early on. I won't go into what our personal financial situation is, although I think that a great deal more money is tied up in our Motley Fool private stock than it is in our personal portfolios. But the key for, I think, everyone is to get people involved at a young age in this. We have had people come into our forum and say, I began investing when I was 11, which David and I did not. I began investing when I was 11, and I now have $3.2 million. And I didn't have that much to begin, but my parents told me that every chance I get, I should buy stock directly from companies, I should minimize what the costs are to investing, and I should get into great companies whose products I use. Not a very sophisticated message, but the sort of thing that lights a fire in fooldom out in the message folders as everyone rushes in to figure out what the magical equation is for doing all of this. It really isn't anything magical, and I think that we're going to see an increasing number of stories that don't focus on the Fool or David and I, but focus on the people in our forum who have been doing this for longer than we have, with greater sophistication than we have, and doing better than we have. And they've done it simply by getting involved at a young age because their parents were very sweet.
I've had a couple of questions on this theme, and let me try to meld two of them together. They say there's no sense in trying to time the market, but do you think that it will continue to climb, or should people start to think about exit strategies? And a more drastic question is, when will the stock market crash? No kidding, are you concerned about this?
One of my favorites, because this enables me to go on one of my tirades, which I'm going to do.
I'll sit down.
Everybody sit down. One of the worst Wall Street maxims, commonly accepted, one of those bits of conventional wisdom which fools are out there fighting, is the good old buy low, sell high. And that's something that if you talk to a casual acquaintance who only casually knows the investment world, they'll go, oh yeah, buy low, sell high. That's the secret. We actually don't believe that that is the way to invest. Let me give you two examples. There's a stock that's at $7 in both cases. In one case, the high for the year is 20 and the low is 5. In the other case of the $7 stock, the high for the year is 7, the low for the year is 2. Which one are you more inclined to buy, all other things remaining equal? The common answer to that question is the first situation. It was already at 20, it's now down at 7, so I bet it has the capacity to go back to 20. I think I'm buying low, and I'll be able to sell high. But our foolish answer is the latter situation, in which you encounter a stock that's now at 7 that is higher than it's ever been before. That's the key. What does something that's higher than it's ever been before tell you? Does it mean it's risky and frothy and scary and something that you should consider jumping out of? That's not the way I think of it. I think of it in terms of the subtext being that things are better than they've ever been before. The company is succeeding probably better than it ever has been before, and the market is recognizing that. Those are two wonderfully bullish examples. And so applying that situation to the overall market, today, our stock market, yesterday, it hit another new all-time. What does that tell me? Well, it tells me that things in America are better than they've ever been before, especially relative to the rest of the world. I think, for example, that we have a wonderful technology lead over the rest of the world, and I think that technology is the most important thing in our world today that you can have for a competitive advantage. And so it's no surprise to me that our stock markets are hitting it and that they're largely being led by our technology stocks. I think a lot of people, that worries them because they don't understand technology and they see everything's doing so well. But I'll just close by saying that I don't foresee the market crashing anytime soon. It will crash at some point, and I won't foresee it when it does. But that doesn't concern me, because the whole point of foolish investing is to buy and hold for the long term, so that if you do have a bad 3 or 5 year period where the market declines a drastic 40%, you can actually just hold right through it, not sweat it, just keep adding your money. At this point, you'll be buying it at a significantly lower price, and therefore probably a better value for the long term, and just keep adding. And that's really our feeling. So we never try to time the market, because we think the biggest mistakes made are by those who are going to try to scare you out of it and say, by the fall, you better get out. And what ends up happening is that the year forward past the fall ends up being one of the best years, in market history, and you're sitting there just kicking yourself. So we totally get away from that emotional pressure, and as Tom was saying earlier, just buy and hold.
You rail against the institutions of Wall Street. How will you keep from becoming a guru-type institution?
First of all, going back to Dave's answer, I can't believe he didn't just take a shot at Nostradamus-style prediction and say something like I will, like September 19th of this year at 2 p.m. What was the question? I was thinking of that.
I have no idea. Oh, how are you going to...
Oh, how do we keep from becoming a stuffy, guru-laden institution? I think that the answer to that is to maintain an open company. If we do go public, our aim, which we have talked about internally, is to produce our sales and earnings per share numbers daily in full view, so that 3 days before we announce earnings, we don't step up and go, by the way, we underperformed our sales projections by 40%. And we cashed out of our stock at the end of last quarter when that window opened because we sensed some trouble. We actually want to present things in an open fashion to everyone. And whether or not we can pull that off, we would have to do it before consulting any legal services. But that is going to be our aim, to make the Fool something that we want you to walk away from. We want to build a system for you that you can put into place. We will find ways to grow our businesses, our various businesses, in a lot of different fashions, I think in some atypical or untraditional ways. But our aim is to build a context for you to do this for yourself. So I think that that in itself protects us from becoming an institution that people end up getting sick of. We'll see if we can pull it off, but the emphasis in the online world, in our opinion, is going to be on openness in a way that most businesses don't yet foresee.
Is making money a goal in itself, or do you invest for fun, hoping the money will follow?
The goal of investing is to make money. That's our point of view. We don't touchy-feely invest. We're not trying to feel good about what we're doing. We're trying to make money. That's the goal of investing. The goal of life is not to make money. The goal of life, in my mind, is happiness, and it means different things to different people. My feeling is, and this actually, I'm echoing just a comment that I got in my email box a couple weeks ago, is that money gathers meaning based on the uses that we put to it. And the more money that we have, the more we should be trying to make it work for other people. And that's really our feeling about it. And I'll just leave it right there so we can hit the last question.
But before we do, I have some Press Club gifts for each of you. A certificate suitable for framing for Tom, and for Dave, and our official Press Club mugs. I've seen yours; they look pretty interesting.
These are better looking.
So thank you for appearing here. Now, our last question. I'm sorry we couldn't get to all of them. But the last question is, haven't you met with tremendous resistance from the Wall Street establishment? Tell us a little bit about that.
I'll do the first part of that and let Dave step in if he has any extra thoughts. We have. I think that we have met with tremendous resistance. I think that anytime you run a business that is trying to reform the way business is done, you're going to run into a lot of resistance. So we haven't run simply into resistance from Wall Street. We've occasionally run into it from people that we consider to be our partners, from people that we consider to be neutral, should have been neutral but aren't, have decided to get into this business. And so I think that we're prepared for it. But what we do want to emphasize, and what we have emphasized, is that this is not a zero-sum game. It never really has been in the financial world. And if you look at institutions, you don't really see cutthroat competition. You see internal management of their business as a way to grow it, rather than worrying about what their competitors are doing. And I think that that's what's going to end up happening, again, in an open, digital, consumer-driven environment, that there are going to be so many opportunities for businesses that link together, at least if they're public, their shareholders, their customers, and their employees. They make their customers their employees. Their customers so love the product that they go out and market it. They make their employees their shareholders, and they make their shareholders their customers. They sell them things at shareholders meetings. And so I thought I had... So anyway, I think that I was going to filibuster this. I think that we've run into a lot of resistance, but the people that we haven't run into resistance from are the people that are focused on education in the financial industry, of which there are many, many, many great Wall Street analysts that pick up the phone whenever you call, that want to help. anyone learn how to invest their money. So resistance from some people, and at least the educational side, no.
I'll just add that resistance brings about competition. Competition is a wonderful thing, and those who benefit from it are you and me. 2 more minutes. And can I say that backwards? Actually, if we honestly do have 2 more minutes, what is there another question we can take, Larry? Because I don't really have much to add to that particular one. Should we just start taking random questions from the audience?
No,
Tom is single, by the way.
Actually, thanks, Dave. Let's talk about a couple of the products and services that we have to offer. There's a 900 number.
Today, Saks Fifth Avenue, after announcing some merger or something, opened up and was predicted to go even higher and higher. Conventional wisdom says that consumers are downsized and cautious, so in 35 words or less, why is Saks just such a hot stock?
I know nothing about it. and that gives me a good opportunity to waste about 30 seconds by saying that we really don't know that many situations out there. There are over 9,000 stocks traded on our American exchanges. We only follow about 50 to 100 of them. I think that the media sometimes wants us to think that we have to follow everything, so that, Saks, well, I guess I should feel out of the loop now that I don't know this hot bit of news, but actually it doesn't really concern me and my investments. And so what we're always trying to do is just focus and only pick out those things from companies that we think are important to know, and only pick out those companies that we think that are important to follow. So it gives us a good opportunity to talk about this information age in which there's way too much information, and I think a fair amount of our business and other businesses will succeed based on how well they filter that information.
Dave and Tom, I want to thank you for coming here, and I'd like to thank the staff that has helped put this luncheon together. Melissa Bender, Chad Taylor, Melanie McDermott, and Howard Rothman for organizing today's luncheons, and we are adjourned. Thank you.